Okay, we will get started here. Good afternoon, everybody. My name is Ian Campbell. I'm Vice President of Operations at PASIC. I am the staff lead for the Risk Officers Forum, and I'm your moderator for this afternoon's broadcast. This is our second webinar of the year. We have 160 participants joining us from 60 organizations right across Canada, so welcome everyone, and a special welcome if this is your first time joining us. I want to thank my colleague, Danica Hall, Manager Operations, for her work behind the scenes to ensure a smooth broadcast today. Thank you, Danica. And I remind everybody, this is not just another webinar focused on technical industry issues. I tell my friends we air the top-rated insurance talk show in Canada, and they quickly remind me that you air the only insurance talk show in Canada. So a little bit of fun there. I want you to relax and enjoy the next 90 minutes. We have a very exciting agenda ahead. I'm going to look over some housekeeping items and ask Danica to put up the agenda if I could. I'm going to begin by going over some housekeeping items for you. Then we're going to welcome in our President and CEO, Alistair Campbell, for some words of welcome. I'll take it back and introduce our panel, some subject matter experts that we have on hand today. And then we're going to close the broadcast talking about some upcoming events and our satisfaction survey. So in terms of housekeeping items, everyone in this COVID world is now familiar with the MS Teams platform, and I want to just go over some ground rules to make this session as productive as it can be for all. So thanks for muting your audio and disabling your video. That's going to increase the quality of the broadcast. If you have any questions, you'll see in your taskbar, there is the icon for the hand. We ask you to put your hand up. You'll be recognized, and that way we can field questions in the order that they arise. We want to make this broadcast very conversational, very interactive, and so we invite your questions and comments throughout the broadcast at any time. We have a great topic today. It's very timely, given the ongoing public discussion on this matter. We're looking at environmental, social, and governance scores and the implications for investments and underwriting in the P&C insurance industry. Just if I could ask somebody to please mute their audio there. Thank you. Antitrust compliance, the Competition Act remains in force. There's to be no collusion on business strategies, claims adjusting, coverage, claims resolution, and or third-party service providers. You are and remain industry competitors throughout the broadcast. That satisfies our lawyers. Always love to hear that. The meeting is being recorded for future on-demand rebroadcasts. A copy of this webinar is going to be placed on our website, and this will benefit members that weren't able to join us here today. So now I want to begin by saying hello to our President and CEO, Alistair Campbell. I know Alistair is very excited about this webinar. I'm just more worried that he's more excited about his improving performance in our office hockey pools. So welcome, Alistair, and you can provide some words of welcome. Thank you.
Thank you, Ian. You're still ahead of me, so I don't think you have that much to worry about on the hockey pool front. Thanks for the intro. I will be brief, folks, because I think we have such a stellar panel here. But I did want to provide one quick PASIC update on another topic. Last week, we released our latest update on the P&C industry model in a research paper authored by our chief economist, Grant Kelly, entitled How Big is Too Big? The Tipping Point for Systemic Failure. And in it, we updated the work done in 2013 and 2016 with refreshed industry data and much more up-to-date perspectives on reinsurance purchases in the industry, et cetera, and came to some important conclusions. Very briefly, our industry is now in a position to withstand a single natural catastrophe event of 30 billion insured losses before the first insolvencies are anticipated. Of course, there could be somebody who gets their aggregations wrong, but the model suggests that up to that level, we're okay. But between 30 and 35 billion, there would be failures. We would have decent prospects for muddling through, but at around 35 billion in insured losses, we would face systemic failure of the industry, partly triggered by the PASIC assessments, which would be levied on the surviving companies to fund the claims payments for the policyholders of failed insurers. That 35 billion number has not budged from 2016, and that by itself is of interest. But new in this paper, we modeled Quebec separately from British Columbia While the probabilities are different for Montreal-Ottawa corridor quake than they are for a BC quake, the probability exists. And so we thought it was useful to take a look at the very different structure of the industry there, different take-up rates for quake cover, et cetera, and understand the implications. The 35 billion number works out in the model a different way, but it turns out to be the same tipping point. Also in this paper, we did something completely new, which was introduce some sensitivity analysis. We explored public policy alternatives. PASIC does nothing and chooses not to help and stands aside and leaves the problem with government. What would that do? It would avert the assessments that cause some of the systemic contagion, but millions, tens of millions of policyholders would be out of luck on their claims and have to go to court for the 10 to 15 year process. Unattractive scenario, we're pretty sure, with dire consequences for the future regulatory environment for the industry that would inflict that outcome on Canadians. We also explored increasing regulatory forbearance and whether there was room. We explored the use of PASIC's resolution protocol, our new protocol. What if we were to rescue some companies, the ones that were kind of walking wounded, and in the end concluded that none of those obvious public policy alternatives worked. We also modeled, at last point here, the costs to the industry and to the governments if they were to intervene instead through some form of liquidity provision, some kind of backstop mechanism. And that's the most accurate we've ever produced, and a quite compelling illustration of why it is imperative that we as an industry prevail upon the federal government to move forward with some form of backstop mechanism that will address this systemic risk. We continue to hope that the experience of COVID will demonstrate compellingly the merits of having a, in case of emergency break glass plan in advance for tail risk events, especially those that are severe and entirely plausible, such as the major quake. So we're very proud of this paper. Grant Kelly did stupendous work on it. Copies are available, of course, on our website, as is the video link to the presentation that he and I gave last week on this subject. I know that many of the participants on this call did attend that, but if you missed it, it's worth your time. And I would encourage you to pay attention. Now to the subject at hand. We're an industry of acronyms, and as an industry, we know a lot of them. Underwriters would think in PML terms. Actuaries would think of IBNR or PFADs. At PASIC, we obsess about MCT and ORSA. But it is rare for an acronym to become such a big deal so fast as the new and very important to understand acronym ESG. And so early on this year, when we were working out what our agenda of webinars would be, our Risk Officers Advisory Committee flagged this as a worthy topic. And we have now lined up, I think, a stupendous panel to help us understand it better. So I'm going to get out of the way and let the talk show host take over. Ian, over to you. Looking forward to the discussion.
Thank you, Alistair. Okay, it's my pleasure to introduce our panel, and they are going to provide completely different perspectives on this topic, which we thought would be really good to give you a lay of the land approach to ESG. So our first panelist is Allison Slater, Senior Director of Sustainable Finance with the Global Risk Institute in Financial Services. Welcome, Allison. Thank you for being here. Carl Lussier, Assistant Vice President, Personal Lines Projects from Economical Insurance is joining us as well. And also Aaron White, Client Portfolio Manager, Equities with CIBC Asset Management. So we had a little pre-meeting on this, and Aaron drew the short straw that she is going to go first and do a level set for, I guess, just to ensure we all have a common understanding about ESG, what we're talking about, why this is of concern to the industry. And then Carl's going to talk about this from the industry perspective as somebody actively involved from the inside. And then Aaron is, as a fund manager, is going to talk about our industry and trends he's seeing and observations. And then at any time, we have an hour and a half. So questions, comments, probably as they're valid and timely, raise them as they're going through their presentation. If you have an issue or a concern or a question, it's not so much a got you, but just to open up discussion. We certainly invite you to put your hand up and you'll be recognized. And it's easier doing that than in the chat box if you want to field a question or a comment, but we certainly do welcome you to use the chat box as well. So I'll throw it over to Allison, and the panel will take it from there. Thank you.
Well, thank you very much. I appreciate it a lot, Ian and Alistair. I'm just so very happy to be here today, along with Carl and Aaron, to talk about this. The Global Risk Institute is a frequent collaborator with PASIC, where we are also a member-based organization with about 45 firms, I guess, across banking, pensions, insurance, financial crowns, and others. We focus on risk. Building on a decade of supporting financial risk management, we've expanded to cover emerging risks like cybersecurity, geopolitical risk, and now climate risk, which is the program that I lead at GRI. So I'm happy to provide a bit of a level set or a backgrounder on ESG ratings in particular. I mean, the ESG topic is just so broad and wide. We could talk about this all day, all different aspects, but I'll look at ratings, rankings, and indexes and just sort of provide that level set food for thought, and then look forward to hearing from Carl and Aaron on how they're actually interacting with these. So this is sort of based on my observations of the growth and change in the field over the past 2 decades or so. I was just looking up the stats today. Global flows into ESG funds topped 180 billion in the first quarter of this year. That's up from 46 billion in the same quarter last year. So that's a stunning amount of growth. And an important part of this market infrastructure related to all this are ESG ratings. There are no fewer than about 600 such ratings, rankings, or indices out there today, and fund managers use some of these to gauge whether or not a firm is a good performer in this space and therefore worthy of an ESG or similar sort of a label. So it's worth diving into these ratings and understanding the basics, at least at a high level, about how they work. Danica, could you move ahead to slide 3? We started to see these sorts of ratings as early as 20 years ago with big names like the FTSE for Good and the Dow Jones Sustainability Index, along with hundreds of smaller initiatives that continue to grow today. For example, I again saw another announcement. I think it was just yesterday, the investor-backed World Benchmark Initiative announced that they plan to rate 500 firms for their impacts on nature, which is an increasing area of concern in the context of climate change, for example. The aim is to try and connect social and environmental issues to company performance and value, and to better connect financial markets to these issues, to try and build awareness among providers of capital about the risks and benefits of these ESG issues that these ESG issues pose to issuers. And some of these ratings aim to drive better performance on an issue, like human rights, for example, but others really try to help investors find alpha, put their money into well-managed companies. This slide shows a snapshot of what is meant maybe by ESG. You can see some of the sample issues that fall under the headings: environmental, social, and governance. One that's often missing from the acronym in my mind is economic performance or impacts. That's different than financial performance, but so this would be topics like taxes paid and jobs provided, often an area of positive impact that companies have. But we'll get into these topics a little more deeply in a moment. I wanted to just look at the left-hand column. So ratings agencies or initiatives draw from a variety of data sources. Could be from financial filings, annual reports, voluntary disclosures such as sustainability reports and similar sorts of communications from issuers. Some agencies even create their own questionnaires that they send to firms in an effort to try to get more specific and detailed information that's not readily available through the public channels. This has led to a phenomenon known as questionnaire fatigue, where some of our larger firms could receive dozens of such questionnaires annually from different groups seeking to rank or rate them to facilitate the flow of information to investors usually. Among the best known of these questionnaires is CDP, formerly the Carbon Disclosure Project, but it's been running for about 20 years now and is one of the world's leading data sets on climate risk. The media is an important source for data. Many of the larger indices do use AI to scour the internet, mainly for negative stories about issuers' activities or impingement on the environment or on people, in an effort to try to capture that risk perception element and possibly incidents that go unreported. And finally, what I call here alternative data sources, which is largely modeled data. Since self-reported data or regulatory data, say that might be in government questionnaires or government databases, is not widely available across all listed companies globally on all sustainability issues, rating agencies or projects must fill in the blanks. So they project and they estimate performance, say, for example, even on something like carbon emissions. They'll base it on sector averages and other data points. If the firm or the issuer does not credibly disclose, the agency will take a conservative view and round down. I've heard some of them say they round down by as much as 15%, so that a firm will typically rank worse on an index if it has not disclosed, even if its actual performance is a little better than some that have disclosed. If we could just move ahead to slide 4. This is just a really high-level example of how a rating might work. Each rating tool or product, as I've said, has its own focus or goal. They're not all the same at all. Sometimes these are issues-based, like the one I mentioned earlier about the rating 500 firms on across sectors on their nature impact. Or they could be sector-based, such as this one. It's an example from MSCI, where they compare companies in the same sector across a broad range of issues that they have deemed to be financially material. And that's a really important term if it's not one that you've come across yet in terms of related to ESG. So we're not looking at every single issue under the sun in this rating. We're looking at those that have been determined to be financially material to the sector. And so here's an example of an oil and gas company and the collection of issues on the right. And I won't go through them in all great detail, but you can just sort of scan through there, gives you an idea of the collection of issues that go into their rating. You can imagine that this collection of material issues would look different if this were a tech firm or an agricultural company or an insurance company. I've just put 6 issues up here, but there can be up to 20 or more issues included in a sector-based ESG rating. Some of these, like carbon emissions, are quantitative, but others of these issues, like modern slavery and supply chains and indigenous relations, are more qualitative, can be more difficult to measure. So there are a lot of challenges ranging from getting access to reliable data, coping with both quantitative and qualitative data, then normalizing it so it can be assessed and compared. Rating agencies do this work because some of them do this work because they're motivated by driving better sustainability performance or practice by the company. And those that do that often make all these inner workings transparent. For example, the nature rating, CDP are examples that I expect you'll be able to look under the hood and understand a little bit more about the decisions they've made, the assumptions, and how this has all worked. But for the commercial providers, this can sometimes be the secret sauce, and it can feel to companies and other users like a black box sometimes. Investors, now with the inflows and the importance of these ESG ratings rising as a part of market infrastructure, investors are coming forward with more and more questions about how things are weighed and how they're assessed and how the data is modeled and more. And we'll probably hear about some of that with some of our panelists, my fellow panelists in a moment. If we move ahead to slide 5, I just wanted to give a very high level, and it's a little bit simplistic, but just a very high level case and snapshot to show how important it is to know what the rating is actually aiming to do. So as an investor, you need the right tool for the right job. And it's important to note that all these ratings really have a different purpose. So here are the ratings from last week from 2 leading mainstream commercial providers for the same company, Tesla. You'll see that they do rate it by sector. So in both cases, they're rating Tesla against other automobile companies. But funnily enough, Tesla comes out at opposite ends of the rating list, let's say, on each of these 2 ratings. It's really interesting. So on the left-hand side, we've got Sustainalytics, which is now majority owned by Morningstar, but one of the pioneering firms in this space over the last 20 years. They put Tesla in the bottom 30 percentile out of all automobile companies, whereas MSCI, well known to us, we use their data and mainstream financial analysis all the time. They've had Tesla in the top 30 percentile for the last little while. Why? They are ranking and rating and weighing very different things. So Sustainalytics says, well, the corporate governance is fairly poor. They're ranking poorly on corporate governance. They're worried about product governance. There's been outbreaks of coronavirus in factories that shouldn't have been opened under public health orders in California. So business ethics, as we know, they've been in the news a lot. So for these reasons, which are more operational in nature, Sustainalytics they've been scored lower on this rating because that is the focus of the Sustainalytics rating. Whereas MSCI was sort of saying, what's important to us, not so much about how it's run, it's that this product and all around it is a part of the solution we're looking for. This is a part of the movement we need to a low carbon future. This is we're talking about electric vehicles. This is inherently a more sustainable product and business model than anything else that we can see in the automobile sector. So they're ranking higher on the index. Totally different values, totally different purpose of these rankings and ratings. And I'm just going to be following it in the next week or two because they have announced just this week that Tesla will no longer accept Bitcoin because of its environmental impact, because of the energy use it costs to create Bitcoin. So we'll see, and that's been a really important part of the Tesla business model. So let's see how that plays through the rankings and ratings. You can see on the right that MSCI has actually started to downgrade Tesla, which actually tracks what's going on in the mainstream market. But just a snapshot, it's far more complicated than that, but just to sort of show how one company can be on the top of some lists and on the bottom of other lists, depending on what it is that the rating is trying to get to. And if we could just move ahead to slide 6. So some of the values, I thought I'd end with just sort of the good things about some of these ratings and maybe some of the things that we're hoping for improvement, and then I'll just wrap up. In the end, I think these are used, they've done so much over the past 20 years to help drive better disclosure and reporting, to help standardize this sort of data. They've given investors and others the tools they need to engage with companies about their actual performance, about improving performance, reducing risk in some of these areas, improving, putting those longer term targets, improving overall performance on environmental and social issues. They've done so much to bring comparability especially across sectors, to try to start moving us towards some agreement about what are the material issues for each sector. Because when we first started this whole thing 20 years ago, every company was expected to report on every issue. And over time, we've really started to have that dialogue, and the ratings have been a big important part of identifying what are really the financially material risks and the financially material issues of interest to investors in particular. Doesn't mean there aren't other issues that companies are looking at, but what are the set of interest to investors? I think bringing that comparability has been very helpful. The contribution to the field of risk management, I think, has been amazing. This has been helping to uncover issues that typically have sat outside of the enterprise risk management framework, something happening, something hard to measure, something happening in the social or environmental sphere, bringing that in, giving companies and their stakeholders more information and the tools to measure and manage these risks. And I think that performance driving, I think it's just become a bit of a staple. Our best managed companies are on the top of these lists. So it's just sort of, we've got these risks in hand. We've got best practice and governance. We're being transparent about it. We're looking after our environmental footprint. We've got this in hand. And I just think it's been a part of driving some of that better performance. And the next slide. Here are some of the drawbacks. And a lot of the drawbacks are related to this field coming of age, I think, really. And in the last year, with the inflows at the level that they are, it's causing the rapid sort of innovation and professionalization of this field. So this first point about inconsistency, it's actually a debatable point. Sometimes companies are ranked higher and lower. Sometimes it could be because of inconsistent data and methodology, but other times it's because of the different philosophy behind each of the ratings. And there's some big debate. Maybe we don't want all the ratings to look the same. I think that flavor and that character is really, really good sort of preserve. You just have to understand what you're looking at. So this is an area of debate. The data availability remains a big issue, with almost half of the data used in these ratings being modeled or estimated or coming from other alternative data sources. This is an issue. We need that real data, and this will remain a problem until this sort of ESG reporting, until that is sort of mandatory across, all major markets of the world. We're going to have gaps. So this is an area where investors have been doing a lot to work with issuers and demand that better reporting, better quality data, more broad reporting on broader issues. So this is an area where there's definitely a lot of work underway. There's been a lot of improvements in the last couple of years, but big gaps remain. I think the methodology is also really innovating. I think for many years this started out of people's garages, and mostly people who were driven by the issue. Rather than by people looking at this from a core business or financial analyst perspective. So really bridging the gap between environmental and social data and the sort of techniques and methodologies that we use in financial analysis and modeling. This bridge is still being built. So there's a lot of innovation and maturation that is happening. A few other things. Yeah, the other one that I pointed out, that Tesla issue, the counterintuitiveness there. Is this ranking and rating our operational performance, or is this ranking our preparedness for a low carbon future, or our ability to remain competitive in a changing world? Are we contributing, as our products and services or in the way we do things, contributing to making the world a better place, contributing to those sustainable development goals, positioning us in a favorable way for as we transition, in light of climate change and low carbon transition or major physical risks coming upon us from climate change? Are we resilient to that? So is it operational or is it strategic? And so this is sort of a fork in the road that we see. Also on the timeliness side, a lot of these ratings are annual. So you might have, just that once a year issuance of this rating. Whereas, as investors pick this up, we're wanting more real time, or at least quarterly, better connected to major events, better connected to financial results being reported, that sort of thing. So timeliness is a bit of an issue. And just last slide, and I actually am going to leave a lot of this one. I just wanted to say, I'd mentioned that there are 600 of these ratings. There's a lot of M&A going on right now in this space. There's a lot of, there's been a lot of capacity and capability bubbling up all around the world on ESG ranking and rating, whether it be issue expertise, whether it be sector-based and everything in between. And so a lot of the bigger firms, and I've mentioned some of their names today, but there are a lot of other ones out there, mainstream firms that we rely on today for our financial data, are buying up a lot of these firms. So we're gonna see in the next couple of years, I think a lot more amalgamation in this space. And a big jump forward in terms of methodology, data, and maybe focus for what these ratings are, what each rating is actually trying to do and try to achieve, what they're trying to provide, I think, for investors. But I thought I'd leave it there because I know that Carl and Aaron are busy in this space and probably bring some of these other points to life in their remarks. So thanks very much for the stage.
That's great, Allison. Thank you very much. And now we'll turn the floor over to Carl and talk about ESG from the industry perspective. Over to you, Carl. Thanks.
Well, thanks, Jan. And thank you, Allison, for setting the stage. As you've actually been mentioning it, like ESG is an all-encompassing. It's actually like there are so many reports and that could actually fill libraries. Okay, there's a lot of ink that's actually being like spelled right now. So like what I actually decided to focus on for today is actually really the measurement approach that actually will matter to the industry from an insider's view. So I will focus on like some specific event. I am not going to be focusing on like the broad categorization of rating. Everything that you're going to see here is actually in the public domain. There is nothing that's actually like a private domain. Okay, and so on we go. If we could go to slide 3, which is actually going to be like what I'm going to call, we'll start with the E of ESG, which I'm actually calling like the much easier E, okay, which is the environment. One of the things that we can actually observe, like, by using multiple index, and here I'm actually portraying the actuaries climate index, is that like as the climate change, And the short answer for this is yes, across the country. Why? It's actually not much, like there's actually a lot of reports which are actually explaining this, okay? But once we actually start comparing the period of 1960 to 1990s, and then the period of actually like after the 1990s, what we're actually observing is that extreme events, which are very well captured by the actuarial climate index, are actually increasing at a rapid pace, okay? By extreme event, I do mean like, will the temperature actually hit the 90th percentile of what it was like, over the reference period, 1960s to 1990s? Will it actually like be in the low 10th percentile? Will actually like climate be super dry? Are windstorm actually going to be more powerful? Precipitation more dense, okay, than like what they were before? And to all of those questions, like once you actually start aggregating those impacts, the answer becomes that you're actually going to have like an increasing trend over time that like events are going to be having, like the weather is actually changing. Now, if we focus, slide 4, please. If we're going to be focusing, okay, this is a busy slide. The red line is the same line as what we actually had before, like on slide 3, which is the aggregate view of all the events that are actually happening like in Canada. But if we focus on temperature above the 90th percentile, temperature below the 10th percentile, and wind power, what we're seeing is that there's definitely an increasing trend of having a much more warm day, a decreasing trend of having cold day, and then like the wind power is actually increasing when it's actually well measured. Those are actually interesting aspects because they actually lead to like confluence of event, but one of them is actually of specific concern of the industry, and that's actually wildfire. Okay, like in order to actually get wildfire, what you need to get is need to be dried, it need to be hot, and there need to be like a lot of wind. That's going to be leading to like significantly higher wildfire potential, which if we move to slide 5, what I took here is the National Forestry database that's actually maintained by the federal government. On the X1, what you actually are seeing is the average area of each fire that's actually burning in time. Okay, I denoted year over year by the dotted line, but the average and the exponential regression by the large solid line. And so what we're actually like trying to see here is like, is each fire that's actually that's burning over time actually bigger? In short, yes, because the condition for this is actually like happening. Is it actually correlated? Well, you don't see a correlation in the number of wildfire, but you do see a correlation in the average area that each of them is actually going to be burning. Okay. We also starting to see a correlation in the total area that's actually burning on a year-over-year basis. And so this is actually like of concern, as what we actually don't want to see like is another Fort McMurray or another like Slave Lake. Okay. Now, in the previous slide, what I was actually mentioning was that the wind power was actually increasing. Well, is wind power also increasing like for losses? The answer is also yes. What we actually will recall, a few years ago, we had a windstorm in Ontario. We believe that 11,000 homes actually had to get their roof replaced. Okay, similar story happened in Sept-Îles a few years back, and then like the Atlantic provinces are actually subject to like tailwind and hurricane like quite frequently. When I'm starting to map, like if I'm going back to wildfire, when I'm actually starting to map the wildfire on slide 6, okay, what you are actually seeing is that there is actually definitely a pattern that's happening across the country for like, yes, they are actually concentrated in the north. However, they've actually also been like expanding to certain like southern latitude. So as a first step for me, like to actually like take a look into those events is like, my question was, okay, well, is climate changing? And what we actually can see is the answer is yes, but does the climate also have an impact on the potential for losses that the industry may actually face? And the answer to that one is also yes. Therefore, like we should actually pay attention to it, okay? Now I'm gonna go to the much harder S part of the ESG rating, which actually is going to be like the measurement of social risk and the reputational risk that actually happen with it. If you could advance to slide 8. Social risk is actually like, with respect to ESG, is actually like related to fairness or bias in the algorithm. There is actually a lot of algorithms which are actually being used at the moment, especially like in AI, which are using a lot of data. Okay. Now, everybody is going to agree that like when it comes down to the respect of the law, well, there is no argument. Like, you know, the law is the law, therefore we need to respect it. And if you disagree, then like, you know, you go in front of the judge and then like we actually argue the case and then like it actually becomes case law. Okay. However, one of the things that like there can be different perception or definition of what fairness will mean. Okay. In some cases, fairness will be seen as procedural, which is like whether most of the regulatory framework is actually being written with. Okay. However, there more and more we seem to have like a narrative of like fairness actually being seen as distributive, and how are the outcome actually spread in the various groups. Now, in order to actually see this, it's like we need to start demonstrating, well, what is a distribution across the various groups? And are we actually like impacting some protected class, either through the use of proxies or through the use of like the combination of factors, which actually would become like machine learning? The question that as an industry we do need to ask is our definition of fairness keeping track with the changes that are actually happening like in time? Okay. Well, the same definition that was present 30 years ago is actually like valid today. Once we have a definition, if you could actually go to slide 9, and I would actually say like really, once we actually have a definition, then it becomes like quite easy to say, well, what is the measurement that I will be able to apply to actually see like this definition true? And what would be the impact using such a definition? One of the things that we can actually look at, and most of the algorithms in Canada are going to be built in such a manner, is that like we will actually avoid having what I'm going to call disparate intent. So any of the protected class or any of the groups which we actually like, you know, we don't want to be seen as, I'm going to call it targeting those groups. Well, we're never going to be like using those variables in a model. Okay. Well, this can harm the utility of the model, and when we're actually doing some social research or seeing like if we actually do have an impact. Another way that we're going to be having to measure it, however, is that if we actually take a look at those protected group, it's like we can actually start taking a look at like, well, what is the model performance, either in misclassification rate, measurement errors among the protected group, to say like, well, are we achieving the same type of measurement errors or performance characteristic, which are actually going to be like influencing the decision as to like what we should be doing. A third aspect would be like that we actually intend to calibrate from a social aspect to say like, well, if my model is actually expecting X, like for a protected group A, be it indigenous people, people of racialized background, then like maybe I should actually also be expecting X for the non-protected group. Okay. That calibration is actually going to be like leading to some result in order to actually avoid the disparate impact. Now, here's the interesting thing. You will be able to get some of these aspects jointly. You will never be able to get all of them at the same time. You cannot actually have an answer which actually will be what I'm going to call the algorithm being unaware and therefore avoiding the disparate intent and actually like being able to calibrate at the same time. This actually is just going to work. Similarly, for the model performance and the characteristic under consideration, you will not be able to say, well, okay, what is my model performance in light of those characteristics if I am actually not able to actually measure? As such, but once you're able to do measurement, let's move to the next slide, please. What can you do with it? Well, as a regulator in the UK, the Financial Conduct Authority decided like to say, well, okay, we have price discrimination. Should we be acting on price discrimination or any form of discrimination or like, you know, following our definition of fairness? Okay. Which led to the creation of an intervention framework, which I found it like to be quite fascinating because they actually are able to say, well, okay, let's actually like answer qualitatively who's harmed by price discrimination. How much are these individuals actually being harmed? What's the harm that's actually like what is the pool of people that's actually being harmed? And is the product essential? And how does society view currently this form of discrimination? Is it actually egregious or is it actually unfair? Is it actually unfair? And therefore, will I actually have to intervene in the matter? Now, having the framework actually allows us to say, well, okay, from the definition, following the measurement, I can actually see like what I'm actually going to be able to do. And so this becomes quite an interesting concept to use because you're actually saying, well, okay, what's my definition of fairness first? Am I able to measure for this fairness? And then like, am I actually able to act on it? Okay. I want to take COVID as a live science experiment, and I'm really calling it a live science experiment because like the change in the policy that actually have been happening over the past many weeks here in Ontario has actually been quite fascinating from my standpoint. If we were to actually backtrack in March, for those of you that were actually in Ontario, the COVID vaccines that were actually being received were most likely, it was strictly by age bracket that it was actually being distributed. And it was like, distributed per capita across like the various health units across the region, okay? However, like starting in mid-March, you started having like investigative journalists and like this city data that were actually being published, which actually started saying, well, why are we distributing the vaccine like in regions which actually have like limited case of COVID? And so like the impact was actually like not being and why am I actually distributing vaccines, which were actually in region with limited case of COVID, when I have Toronto, like especially in some neighborhood and FSAs, which actually are having like a much higher incidence rate. Okay, so if my definition of fairness distributing the vaccine, or actually like trying to negate the chance of actually getting COVID, and therefore like eradicating the hotspot, so to speak. It definitely led to a change in strategy at the government level, which actually led to like, I think it was 50% of all the vaccine actually being distributed to those hotspots. So from a change in the definition of the fairness of what was fair, like you were able to measure like what were the impact and saying like, okay, well, should I actually, and like applying the framework of the decision they had, say, hey, we actually have an arm that's created here by not actually acting on it or by distributing the vaccine, okay? Now, this is only one example. What I'm actually like, there was actually been a lot of report that would actually have said like the similar concept, especially like in legal literature, like the Globe and Mail run an investigation into like recidivism rate and prison sentence. There is actually like, which were actually called actuarially fair, okay? But then like we're penalizing different subgroup of people that were actually all characteristic that were not being accounted for, okay? So we have to ask ourselves, as an industry, would there be like any practices that would actually be subject, now that you actually have all of those people outside of this group, which have the tools to measure metric, would there be any other practice that would actually be subject to be creating a new narrative of fairness? Last, if you could move on to the last slide, like just some other thought, okay? On the environment, do we actually measure our impact well enough to avoid any form of regulatory intervention? Okay, are we providing like sufficient disclosure? Are we actually having like a sufficient impact of what we're providing as coverage to actually say that we will actually avoid a regulatory intervention? Insurance is seen as an enabler of economic activity. Without insurance, you would have much more reduced pie of economic activity, okay? And as society's perception is shifting, I would actually ask this group, it's like, what are the actions that the industry needs to perform in order to avoid being caught in the shift, or to actually maybe lead the shift? And the last question that we could actually ask ourselves is, well, what are the accepted current practice, which in light of, let's say, alternatives which are actually coming to the fore, we could see disappear, okay? Would the onus of the burden of proof actually be on other people outside of the industry to tell us like how to actually act, or would the onus and the burden of proof lies with us to actually say like, okay, maybe we should actually change? And so those are all good questions. Those are the questions that like we're gonna have to grapple with as an industry. And those were actually my comment. So thank you very much. Yeah, I'm leaving.
Great, Carl. Thank you very much. Those are thoughts from the inside from somebody who deals with this every day, and good rhetorical questions for later on for a group discussion with all of our attendees. So now let's throw it over to Aaron, and he'll give you thoughts from the perspective of a funds manager. Thanks, Aaron.
Thanks so much, Ian. And I definitely have to thank Allison and Carl because they've set the stage really well for me in terms of what we're trying to accomplish as an investment manager when it comes to client outcomes. So there's really sort of two umbrellas with which we attempt to look at ESG ratings, ESG risk, as well as ESG opportunity, and that is essentially looking to enhance risk-adjusted returns for our broader portfolios through integrating ESG risk into our fundamental analysis. And then secondly, looking for what we would determine as more values alignment for our clients to ensure that the investment vehicles with which they invest with us do in fact align with their personal values and ambitions. So if we can flip to the first slide, please. Great. So I want to set a stage in terms of CIBC Asset Management's growth within this industry, and we have been investing from a socially responsible perspective for over 20 years, predominantly with religious-based organizations looking for values-based exclusions to their strategies. But we have also considered ESG risk historically through our fundamental analysis process. However, over the course of the last decade, as Allison highlighted, ESG risk and ratings have become more at the forefront rather than something you did in the background within your financial analysis. And so we undertook in 2017 an investigation. We decided to launch a responsible investing committee and working group, which led to us becoming a United Nations Principle of Responsible Investing signatory, which really has been guiding the industry in terms of standards, reporting, and based on 6 key principles. And this has now eclipsed globally over 3,300 signatories representing $113 trillion of assets under management. And all of those signatories are required to integrate ESG risk into their investment process. So you can imagine with that size of global capital, these risks and ratings are having more meaningful impact on company and issuer valuations, and therefore it becomes more material to consider them over time. We felt that developing our own proprietary process, similar to our own proprietary process for fundamental traditional financial analysis, really helps us add value, add alpha, and as a result of that, in 2018, I've undertaken a process across all of our asset classes at CIBC Asset Management to create those proprietary process, and that includes even some of our larger institutional business in active currency, for example, where there really isn't a lot of third-party rating agency data. And so we have to create that process from the ground up in order to understand those risks to sovereign entities. We've also taken a stance on active engagement within our investee companies and prospective investee companies. We've focused on a lot of collaborative engagements, including becoming founding signatories of things like the RA Canada's Statement on Diversity and Inclusion, the Black North Initiative 30% Club, where we advocate for greater board diversity, gender diversity. And all of this includes continued resource allocation. And so we really do take ESG seriously at CIBC. It's integrated into our DNA, and we have full buy-in across the organization in terms of integrating those considerations into our process. Next slide, please. So this is actually, Allison set the stage for me perfectly here, talking about some of the issues that you would have with third-party rating agencies. Why have we undertaken all this effort to develop a proprietary process and do proprietary research? You know, we look at the rating agency's content much like we would look at sell-side research. It's valuable for comparative analysis. It's valuable as an assurance mechanism if our analysis is broadly very different than what some of the rating agencies have come to the conclusion of. It creates an opportunity for additional review. But really, some of the key challenges that we faced with third-party analysis is the ratings are by and large historical in nature. You know, they're taking data in, creating estimates, and ultimately are basing risk on those considerations. We are very much forward-looking in nature with the intent of understanding what the future risk, non-financial risk of investing in a company or an issuer is. Secondly, Allison talked about the various rating agencies' differing methodology. That is certainly a factor that is of concern when you're trying to take that input and integrate that within your fundamental analysis. But also many of the rating agencies don't take on materiality related to each unique company or each unique sector. We're very much focused on understanding the unique issues related to companies within their own industries, and ensuring that, you know, for example, a mining company has much higher weight put on the environmental risk versus a financial company who would have significantly higher weight on governance risk. And then, as Allison mentioned, with her example on Tesla, there's a very low correlation between all the rating agencies. This has improved over time. When I first started looking at this several years ago at CAM, the correlation was approximately 30% between the different rating agencies. That's increased to about 50%. But for comparison's sake, you know, the various credit rating agencies have a 99% correlation in ratings. And so you're much more beholden, if you're using only third-party research, to the methodology of the provider you've selected and the estimates they've made. Our preference is to receive multiple sources of those estimates and data, as well as backfill that with our own analysts' work through company engagement and management engagement. Alistair, I see you have a
Perfect. Yeah, if you could field Alistair's question, that'd be great. Thank you. You just have to unmute yourself, Alistair.
Yeah, sorry about that. Perfect. I'm quite happy to wait till the end of Aaron's presentation. Okay. Before my question.
Sure. It's sounds great. All three. Thanks.
Okay, great. So next slide then, please. So I mentioned we operate under this process of proprietary independent analysis. Wanted to give you a sense of how that information flows through our team. We organize our analysts at the sector specialist level. We think this sets us apart from some of our peers who maybe have more broad coverage based on specific mandates. So each, you know, investment team will do all of their own analysis. We have a shared group of analysts that cover unique sectors from healthcare all the way through to oil and gas. We have integrated the ESG analysis within those sector specialists. So many of our competitors will have a separate ESG team that will take inputs, they'll arrive at conclusions, they then share that research across to the various portfolio management teams within their organization, creating sort of an information flow where you maybe don't necessarily have as much buy-in or as much stake in the research, the ESG research. All of our sector specialists perform their own ESG research related to every company they cover. They then integrate that analysis with their fundamental view to arrive at the holistic view of the company. The idea being that on a sector relative basis, there should be discounts or premiums placed on particular companies based on the non-financial risk, relative risk that exists within those companies. So, for example, some of the things we're looking to solve for are HSBC's money laundering scandal. We're looking at those policies and the governance policies and procedures that are in place at financial institutions to ensure that, an event like that doesn't happen with one of our investee companies. If you think about Barrick Gold, for example, with the human rights scandal in the past, or BP Oil with their Deep Horizon oil spill, while we can't catch all of that controversy risk, we can price in based on some of the risk that exists or that is identifiable, the risk of those controversies occurring, or just the broad mismanagement or relative mismanagement to other companies within the sector. Flipping to the next slide, please. So to give you a framework of that materiality I spoke of, this is just a snapshot of high level what our materiality map, proprietary materiality map, would look like. The idea is that we arrive at a score for environmental, social, and governance for every company that we cover. We then weight those scores based on the sector with which that company operates within to arrive at a -2 to +2 relative ranking, which has some fundamental component to it, oversight component to it at the analyst level. And then those scores will essentially represent within its own sector the sort of discount or premium we might place on a company to arrive at our holistic fundamental view. And last, next slide. So this will build a little bit off of what Carl was speaking about, and trying to understand some of these systemic tail risks that exist within our industry related to climate change. And so we do report as a broader organization at CIBC under Task Force for Climate-Related Financial Disclosures. Part of our obligation there is to stress test and scenario analysis our portfolios against some climate scenarios. I've just put a high-level snapshot here of some of the analysis that we undertook at the beginning of this year, looking at things like in an environment where globally we achieve the objective of only 1.5 degree warming, what are some of the consensus in terms of things like carbon tax, which we're arriving at approximately about $100 levy on carbon. What would happen to rising sea levels in those environments? Ultimately, what happens to global oil and gas demand as a result of that carbon price? And ultimately, what does that cost every company within their operations as they have to pay that price on emissions? And so we stress test and do scenario analysis on portfolios to sort of try and understand some of the consequences of these issues and what that ultimately would mean for risk as we look much further out into the climate crisis. I've left you a couple of interesting images here. That's a global oil cost curve. You can see that Canada is actually, it's probably difficult to see, but Canada is actually one of the higher cost producers. So as you start to pull oil and gas demand out due to improving renewable technologies, but also instituting carbon prices that sucks demand, Canada will, and our oil and gas sector will be one of the harder hit sectors because of that break-even price. Depending on the company in Canada, we would estimate somewhere between high $20 to $40 a barrel is their actual break-even cost. And so as oil demand declines and prices start to hit those levels, you start to see erosion of certainly equity investors' capital and a much greater challenge for payback of debt. The second image there, this is actually under a 4-degree warming scenario based on the Climate Center's forecasts and overlaid on top of a Google Earth map. But that's what Vancouver would look like under a 4-degree warming scenario based on rising sea levels. And so part of our analysis is looking at things like REITs, and other companies that might own real estate in coastal environments. And while it's not as big of an issue for Canadian investors as it might be for US investors, it certainly can have some implications in terms of ongoing costs of operations as we consider things like higher insurance costs or maybe increased property tax as a result of having to build levees, et cetera, throughout those coastal regions. Or ultimately in a 4-degree warming scenario like this in Vancouver, where you're going to have meaningful write-offs in terms of property damages due to inaccessibility of major components of Vancouver real estate. So it's just trying to understand, while some of these scenarios are maybe not imminently likely, what could potentially start to get priced into securities over time as we start to get a better understanding of the trajectory of this crisis. And maybe anecdotally, it's interesting as you talk about some of this rising sea levels today, relevant to this group, is we reached out to the investor relations group as part of this analysis and some of our larger insurance company investee companies to find out if they had any models related to premiums and what might happen to premiums or what could happen to the balance sheet as under these scenarios. And quite widely, the response we got is it wasn't something that had been looked at yet. So these are scenarios that are possible, certainly under the 1.5 or 2-degree warming scenarios, and certainly very much worth underwriting and actuarial work related to what could potentially occur as a result. So with that, Alistair, I think you had a question. I'm happy to start there, or we can open things up to the general line.
Let's throw it to Alistair, and then other people out there, if you have questions while Alistair's putting his questions across to the panel, maybe just put your hand up if you have a question. You'll be recognized next. Thank you.
Well, first of all, thanks to all three of you for very thought-provoking and quite distinctly different packages of information. So I've just been trying to think through how to incorporate that, and then I have one specific question. So if we think about capital allocation, starting with like the East India Company or the Hudson Bay Company, your only investment filter would have been legal or not. But over time, we evolved as humanity and got to a increased and enhanced filter where you would have legality and some version of ethicality and morality attached to the decisions by the boards of directors of capitalist enterprises. And then more recently, obviously, a very rational and decent integration of more social consciousness. And obviously, we haven't got as far as we need to on that. The dialogue around systemic racism in the world tells us we have not got to where we want to get to. And then most recently still, you add an E. Now, it's not a small decision to add the E to your investment filter, because the idea of some kind of environmentally conscious filter to how you're impacting nature, or are you emitting carbons, or are you polluting the environment, wasn't in the original framework for how companies think. So Allison has described very nicely how lots of people are trying to help with this, which is why we have 600 scores, and so many of them are producing such different outcomes. I think Carl has illustrated right at the start of his presentation with the curve on environmental volatility in Canada why we should care. But he also, I think, highlighted with his second section just how incredibly complex it is to think about how to apply a score. And kind of the moving target as everybody thinks about fairness in the context of those types of scores. And then Aaron has shown us how smart money people are diligently embedding this new set of thinking into their quest for alpha. And I'm confident they're doing it super well. CIBC invests the passive compensation fund. So in fact, we're counting on them to do super well. So now I just want to get to the specific question, because this is not a small deal for the world, but it could be potentially a huge deal for Canada. So we have 11 or 12% of our GDP coming from oil and gas, and an even larger section of our GDP coming from natural resources. and the extraction of those and the transportation of those and the refinement of those are all the types of things that are being more strictly scrutinized with regard to their environmental impacts. Worldwide, major insurers and financial institutions have been urged to start rationing capital using some form of ESG framework. And until 18 months ago, the focus was thermal coal, which I think we could all agree is not good. But about 18 months ago, suddenly the sentence got expanded to include tar sands or oil sands. And then it suddenly moves from the generic to the very personal, because that's us. And yet it's a big part of our economy. And so in a very short period of time, we've now watched significant capacity withdrawal from the Canadian oil and gas sector by primarily European multinational insurers. The top 10 insurers in the sector represent 70% of global capacity. And so you now have major players in the Alberta economy, Saskatchewan economy, Canadian economy, who are the good guys, investing like crazy to try and mitigate carbon emissions, developing best practices and technology to get better. But they are suddenly discovering, and Carl, I think you said it clearly enough, if you can't get insurance, you can't trade. There is a direct risk that the Canadian economy takes a hit from the implementation of these ESG decisions by the insurance industry. And that makes this all very topical. And I'd welcome the thoughts of any of the three of you or all of the three of you on that. Sorry it took so long, Ian.
It's all good. Let's go to maybe Allison first. Do you want to jump in?
Yeah, I guess absolutely right on the trends, Alistair, that we're seeing. There's this global divestment afoot as many firms, including many of you on the call, are under pressure to align your portfolios with this 2-degree or a net zero goal, a climate goal. And for that reason, I would separate a little bit and let's look separately at operational ESG excellence and reporting. And I think some of our Canadian firms, you're right there, Alistair, have been top of these rankings and ratings for a decade, Suncor and others, because they've taken health and safety, corporate governance, methane capture, emissions, they've lowered down to, as low as humanly possible, the emissions that come from the actual mining and the actual production or collection of oil sands. And so you're seeing that best-in-class performance. And so that on that ESG, of traditional ESG, which has been largely operational, you're seeing that best-in-class performance. And I think the message that we're getting from the international community, a finance community to some degree, at least in Europe, is it's no longer good enough, because what we're looking at is a pivot to a low carbon economy, a pivot to an economy that is not dependent on fossil fuels. And so we're asking, we're going above and beyond the traditional ESG stuff. We're saying, okay, how are you, Suncor, now best in class on this, but how are you positioning yourself for the next 50 years to be an energy company in the next 50 years when we need to cut carbon emissions by 40% in the next 9 years and get down to net zero in the next 20 or 30. And so what they're under pressure to start doing is start thinking, okay, how do we build on our expertise and the history we've got here? How do we do different things, maybe with the resources that we have, to try to put Canada in, keep our energy sector relevant in a low carbon future, and be the hub for carbon capture and storage, be the hub for converting from oil and gas to other, there's a lot of expertise. In fact, Canada's greatest expertise on hydrogen and alternative fuel sources, on carbon capture and storage, is all coming out of the oil patch. So how do we support this industry to make that transition where we got more jobs than ever before? We've got competitive companies that, I think there's still some run left on some of the oil and gas. It's not over. not being switched off overnight. But for that longer term outlook, let's show those providers of capital, and particularly insurance companies who have been among the early movers to pull out of insuring any oil sands related infrastructure. Let's show them what we're doing and where we're going with it. So it's a challenge like never before. It's not saying let's see your best in practice corporate governance. Let's see those. It's saying how are you going to transform the industry to be competitive in the future, and oil sands in particular being called out for its higher footprint in terms of carbon emissions compared to others who can just sort of pull liquid oil right out of the ground. But you bring up that important ethical question, which is, well, in Canada, we pay people well, we look after people, we have great relations, we're working with the Indigenous community, we're doing this right. In other places, maybe not so much so, and they may yet have the opportunity to exploit more of their oil and gas than we may be. And this is a real hard, tough pill to swallow. And I'd love to see a linked up, Team Canada approach across government, finance, and energy, and some of our other sectors, not only in the energy sector, to make that path forward where we can get the most out of what we've got, but we can also be leaders in the future that lies ahead. Let me leave it there. I'm curious to see what others think.
Yeah, maybe I could jump in here
sure.
Just to echo some of the comments that Allison's making. We do view the Canadian oil and gas providers globally as some of the best on an ESG basis. And, the heart at what she's getting at really here is that by divesting from Canadian oil and gas, you will move to lower cost producers with higher capacity. And these would be your Saudi Aramcos, for example, who utilize slave labor, who don't care at all about, governance structures, who have horrible safety records, an unbelievable number of deaths per year in their operations. So this is what you're rewarding when you divest from Canadian oil and gas. And this divestment trend is not limited to the insurance sector. It's also pervasive in my industry, in the investment side of the business. There are now 1,100 global investment owners and managers that have committed to full divestment, which represents $11 trillion globally, and that is only accelerating. So we actually at CIBC, we firmly believe that divestment is not the most opportune way to do this. Engagement and transition financing is the best way to undertake this transformation. But again, we're designed to deliver on our clients' ambitions, and when our clients tell us to divest, we divest on their behalf. So there's we're kind of trying to educate the public in terms of what the best approach is to achieve their values and ultimately achieve a transition economy. And there's lots of instruments that we can do this with. Green bonds, for example, you cannot get enough appetite in the investment world for green issuances. And so that this is a great way that some of our oil and gas companies can finance that transition. And so, it's a very exciting time to be in this business, but we just need to be very careful about how we approach this in Canada.
My co-panelists have actually been summing that up pretty well. So I'll just bring maybe one different angle here. There is actually transition risk, but then for the industry, and especially from an insurance standpoint, I would say that there is also a reputational aspect that needs to be considered as to and are we providing coverage? Should we be providing coverage? And there's going to be multiple different angles by which we actually are going to be able to tackle this question. Okay, my approach here would be, well, okay, I would rather have we should have a position, okay, and each individual player should have a position on the matter before you're forced to create a position, either through activist investing or through activist period. Okay. And why am I saying so is that you run the chance of actually if you actually delay the creation of a position, you run let's say the creation of any form of framework by which you're actually going to be analyzing your ESG risk, you run a greater chance of error while you're actually going to be under pressure. Okay. Well, instead of actually, if you take the time to actually think it through and to say, well, what does this mean to me, and what should I actually be doing as like an entity which is actually Canadian and which actually operates in Canada, and therefore, like, what should we be doing? And so from a reputational standpoint, I would suggest that like the group looks at it and say like, well, should we be developing a position? Yeah,
okay, that's great, Carl. Other questions and comments out there? Do we have? I'll throw it open to the floor. And in the meantime, I was looking. We do an enterprise risk management survey every couple of years, and it's coming up this summer for all our chief risk officers out there. You'll be receiving through your CEO a copy of the survey, and we've seen kind of a natural evolution over time with the larger companies in our industry leading the way, industry best practices, and then it's quickly followed by, so there's a real narrowing of the best practices in the industry. The smaller companies are certainly modeling what's going on right across. It's almost seamless. How we've seen that develop over the last, say, 15 years. Do you see something like this? I'm just looking at stats online about a number of firms with an ESG policy, a code of conduct, environmental policy, health and safety. How many are talking about it at the board level? How many people or how many organizations have personnel in place dealing with this? Do you see kind of a natural evolution with this as well as kind of the next big thing that ERM went through the industry? Everybody's on the same page with best practices there, and this is kind of the new science. This is the new kid on the block that everybody's going to quickly. There'll be less of a learning curve. Everyone's organizations out there are going to jump in on this. You've seen this. Is that safe to say it's going to follow the same evolution, but maybe a much shorter time period?
Well, I think it's interesting because it's sort of one of those things that's integrating across business lines. And I think Aaron's story is amazing to see how ESG has come into the asset management world. I'm working more closely with the chief risk officers and others about how those environmental and social risks are being integrated into enterprise risk management, not sitting alone or in a department somewhere, but are now being integrated as a risk. Not every issue, but climate is one, and there are other issues that are being looked at through that enterprise risk management framework. We're seeing it being integrated at the board level, at the governance. So it's the governance of environmental and social risks. You could think of it that way. So you're seeing board committees take on some of these top line risks, you could say, or issues for the firm, or opportunities, not only downside, always also upside. So I'm feeling like it's more the integration and professionalization across the board, whereas for many years it was kind of a standalone unit, or it might have been in the environment, health and safety unit, or might have been a part of the comms, kind of a sustainability group or something, but maybe a strategic group, but it wasn't maybe integrated across the business. And I think that's my observation, at least where we are, especially in financial sector firms.
Yeah, I mean, I would say from our lens, one of the easiest ways for a company to decrease their cost of capital is to increase disclosures and increase their ESG performance. And so we're seeing at the board level huge pushes across every industry to improve both of those elements. And it's really on the back, I think, of this huge wave of global AUM that is managed in an ESG integrated fashion. So this trend is not going away, and it's becoming an arms race in both the corporate world as well as the investment management world.
Okay, so let's move on. Thank you. Tracy Mann has her hand up. So Tracy, do you want to unmute yourself and put forward your question or your comment, please?
Yeah, thanks for the presentation. It's been quite interesting. I've got two questions. So one is, I know TCFD kind of looks for climate change to be embedded in board mandates, but what about kind of ESG more broadly? Like really ESG can kind of incorporate everything across the organization. So my first question is, are you seeing those being included in actually board mandates, and how is that being done? Is it just climate, or is it ESG more broadly? And is it at the entire board level or at board committee levels?
I do work with the boards of our member firms, so it's banks and pensions, insurance companies, and what I can say is you're not seeing I think you're seeing an interest, sort of board directors who don't have the background or sort of, hungry for information on generally the ESG space and where it is, where we're going. So we're seeing that kind of ESG, broadly speaking, education going on. But at the issue level, what I'm seeing is this hard work, and some of that described by Aaron, that firms are doing to identify those financially material risks or issues to that company. And so, and climate is almost for almost every company has that, but as an insurance firm, there may be two or three other, it's probably a small number of very high profile social or environmental issues that make their way to the board level that are so important for the firm, whether it be for reputation, market reasons, or these sort of the external force of climate change that will come upon us, that find themselves elevated and are usually sitting in committees. So it could be in the investment committee, it could be in the risk oversight committee. It could be maybe they're looking at it only through the reporting side of things. But I am seeing this elevate, and boards working pretty hard to get themselves up to speed or bring on talent where they can be sure to have that oversight capacity and insight capacity and make sure they're helping to steer the company through difficult times. We've seen an era of social upheaval we've not seen before. The pandemic has laid bare so many things that this has done a lot to accelerate, I think, getting boards getting their two hands on the wheel with some of these issues. Not everything, but some of these top issues for firms.
Thanks.
I saw an article in the Globe, actually, I think it was just this week, about the skills, kind of lack of skills that people are trying to hire. They're trying to, I saw your slide there, Aaron, where you're saying building capacity, growing capacity, and just sort of this search for people with the skill set and knowledge background, that maybe they're coming out of the social space, but they've not worked in a financial environment, or it's financial people who want to kind of take this on and grow their knowledge set and be able to operate on the ESG side. But there was this big kind of article about the kind of lack of talent globally. It's not just in Canada, but how people are trying to fill these roles, whether it be board level, right on down through the organization, and there's a skills gap. So this is something that we're learning to do, I think, on the run.
I see Neville Henderson from OSFI has his hand up. So Neville, do you want to unmute yourself, and you can turn on your video if you want, and please pose a question or comment.
Thanks, Ian. Yeah, you talked a lot about the potential impact on Canadian GDP because of dependency on non-environmental assets. And I'm just wondering, a lot of the, especially companies that have long-term liabilities, are heavily invested in sovereigns, which depend on GDP. And there is a lot of talk in the industry and internationally about stranded assets over time. And of course, there are two aspects to that. Because of Canada's heavy dependence, what is the potential downside in the value of those assets? And the other question, do you have any sense for how quickly that could happen? It seems to be accelerating now. I know there are a lot of new green assets being offered. Many of them don't have a rating history, so it's hard to come up with a capital charge for those. But those are key issues that we're interested in the insurance industry. So I'm wondering, any comments around that?
Yeah, maybe I can just talk a little bit about stranded assets. And, I think it really depends on how you value the company when it comes to ultimately stranding the assets. So, often we're looking at discounted cash flows over, much shorter period of time for industries within the oil and gas or mining sector that might have non-renewable resources. And so, ultimate risk as an investor is on a very short-term time horizon. And so it's a little bit more complicated in terms of, company valuation, in terms of stock market devaluation relative to some of those stranded assets. But that's really what we try and work on through through understanding some scenario and stress testing and analysis that I alluded to in my presentation, and trying to understand where that global cost curve is going to go for assets, and ultimately what that means for how much of that resource can be left in the ground. When it comes to evaluating on a GDP basis, we do also do ESG risk for sovereign entities. We do it on a proprietary basis. And I will tell you that Canada over the years has negative momentum on our analysis, and a lot of it has to do with conflicting policy at the government level, inability to act on some of the climate regulation, and so those risks ultimately get priced over time into Canadian debt issuance, et cetera, which have reverberating effects across the economy. So hopefully that answered your question from our perspective.
Okay. No one wants to talk to the potential impact on the value of assets.
Hey, look, I mean, for stranded assets, if it depends what we model, right? So if we model 30% demand degradation in oil and gas, that takes oil prices to $30 to $35, which ultimately takes off 50 to 60% of oil sands production, which means you can basically write off probably 50 to 60% of equity valuations and of the debt for those issuers. So, if that's 12% of the TSX, you could see a 6% hit to the TSX as a result of an event like that. Now, the fact that that occurrence isn't going to take place overnight. That this is a 15-year time horizon. These things get priced into securities more and more over time. In fact, we have a piece that we put together that looks at oil and gas stocks and compares them to tobacco stocks in the 80s, because you've had these events in 2015 where oil prices collapsed. You had equity valuations collapse. You've then had renormalization of the price of oil with some blips through COVID, but a renormalization of that oil price. But you've never had the multiples come back into the oil and gas companies. So how much of that future risk and how much of that reputational risk and how much of that divestment risk is already priced into the securities? So this is where it gets a little bit more murky in terms of, ultimately arriving at a conclusion to what our GDP hit could be or what our market hit could be. And there's lots of differing opinions on that front.
Yeah, I see.
I just want to be respectful of people's time here. We got a couple of quick questions came in the chat, and I want to see if we can throw these at the panel. So with so much difference between ESG ratings, is there space, capacity, appetite for regulators or legislatures to codify or standardize them, or do institutions see their ratings as a proprietary and competitive advantage? We asked the panel to throw that to the panel.
There's been some efforts, voluntary efforts at least. There was something called the Global, I can't remember what it's called, but anyway, an effort to create some principles and standardization for rankings and ratings, mostly in terms of quality, and which didn't, maybe it was before its time, maybe it was a bit early. It's sort of sunsetted in the last couple of years, but it was around, for a good decade, but maybe it was just a little before its time. I'm not 100% sure if we'll see governments sort of regulating, but but there's the de facto standard setting happening in maybe through stock exchanges or through the just sort of the use cases of which of these win and which of these lose, and some of the stock exchanges kind of tracking or building. So I think you'll end up sort of seeing de facto standardization through the choice of some winners of these rating tools, and maybe a separation of the pack rather than regulatory intervention is my guess.
Yeah, and I'll just add, maybe, it's really not possible to regulate something like a financial analysis. So, sell side research comes out and they're all varying opinions. We have our own buy side opinions. You cannot regulate that. And likewise with ESG risk analysis, which ultimately we believe is an alpha driver, you can't regulate that either.
Okay, great. And one more question. What would be, sorry, absolutely, Carl.
Aaron, maybe for you then. You can't regulate sell or buy side, but what about TCFD and the introduction? And right now, TCFD is a voluntary compliance approach. And I was wondering, at some point you were actually mentioning that what was actually disclosed was material mostly. there's opinion as to what's material and what's actually like non-material. And so like I was wondering, like, how would you actually see the emergence of TCFD as being regulated approach?
I mean, yeah, I mean, it's certainly a possibility that becomes mandatory. We've also seen, different accounting standards, SASB, becoming mandatory. If you look to Europe, where you have, classification systems, Article 6, 8, and 9 products, disclosures related to specific standards, it's called SFDR in Europe. That's all coming to North America. We're typically 5 years behind Europe on this front, but it's all coming, and that's where the regulators and governments will likely play a role.
Okay, and the final question, what would be the best first step forward toward development of an effective Team Canada approach?
A hard question to answer in a short period of time, but yeah, you do want to see, it's just, you do want to see there's so much more partnership and in place than maybe seems that you read in the news, especially between the financial sector and the energy sector. And so, I think there's a lot more, we're on the same page more than it seems maybe in the news sometimes, and with strong government leadership. And I think they're shaping up in that direction. We saw some signals in the budget. We've got the new Sustainable Finance Action Council. We've got this net zero target. I feel like we need to bring those major parties together and put the plan together so that we can optimize and really build for that, keep Canada competitive in the future.
Okay, that is probably a good place to wrap up. So I want to thank our panelists today. Allison Slater, Senior Director, Sustainable Finance with the Global Risk Institute in Financial Services. Carl Lussier, Assistant Vice President, Personal Lines Projects, Economical Insurance. And Aaron White, Client Portfolio Manager, Equities, CIBC Asset Management. There's a saying that when you give people what they want, they come out in record numbers. And we had 160 on the line today. So well done. That was a very excellent presentation, very thought-provoking, and one we haven't discussed before in our Emerging Risks webinar series. So thank you very much for being here today. I just really quickly want to jump ahead to upcoming events for everybody out there. September 15th is our next Risk Officers Forum meeting. We're delighted to have Rob Wessling, President and CEO of the Cooperators Group Limited, is going to be talking to us about the CEO perspective on flood resiliency efforts in Canada. We're going to have 2 hour-long conversations as well, one on a reinsurance update, talking about reinsurance trends, exclusions, and capacity. We're going to have broker representatives on that panel. And also, we're going to be talking about the results of our 2021 PASIC ERM benchmark survey. I'm going to be joined by Brandon Blant from Intact and Sonia Kundi from Zurich, Canada, to discuss findings of member practices in ERM. And then October 15th is our next Emerging Risks webinar. We are going to have a panel to be announced with representatives from Munich Re and Swiss Re, talking about the threat to Canada's electrical power grids and communication networks. There is going to be a satisfaction survey that you're going to receive tomorrow. I want to thank you for being on the line today. Very quick, it's going to be a SurveyMonkey 4 questions, and it just helps to get your feedback. It helps to enhance the quality of future broadcasts. We want your ideas on future speakers and subject matter and how you enjoyed today's discussion. Thanks for joining us today. This concludes our meeting. We look forward to having you join us for our forum meeting on September 15th. If COVID keeps barbershops closed in the meantime, you're going to see my evolution into Joey Ramone. I don't know how long my hair is going to get, but in the meantime, stay safe, enjoy your summer, and we'll see you soon. Thank you.